Well, good evening, ladies and gentlemen, and welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now, tonight we're going to talk about passive investing. Again, I know. But I really want to go into this topic in depth because I think that it's the form of investing that is most accessible to everyday people. Now, if you've watched my last videos about passive investing, we sort of explained how it worked, how index funds work, how it can provide slow and steady long-term returns. But there's a few things about passive investing that I thought I really should discuss before anyone actually goes and tries to do it. Now, there are two things that make passive investing successful. The first is time. So that's compound interest working over a very long period of time. Because passive investing is not a way to become rich quick. It's a way to become rich over a very long period of time. And the second key to passive investing is consistency. Now, that means regular, uninterrupted contributions to whatever index you have chosen. And I'll talk about why that's important a bit later. The other thing you have to remember about passive investing is that it is boring. Okay? No one's going to be like, no one who passive invests is going to be the next Jordan Belfort. But it is the simplest and easiest way for average investors to build long-term wealth. Now, the kind of attitude you have to have with passive investing is a very special one. As I said before, it has to be consistent. You have to be consistently adding to your investment. Now, if you've picked one index fund, you have to contribute to that all the time, as regularly as you can. That will ensure the biggest return for you in the long run. Now, if you decide to become a passive investor, here is the number one rule you have to remember. You must never, ever sell your index, any part of it, unless you're in an emergency, unless the bank's about to take your house. If you want to become a successful passive investor, you must never ever sell, okay? Because that defeats the purpose of compound interest. Now, a lot of people will try and say, I'm going to time the market. The market's looking really, really overpriced right now. I'm going to sell it. No, that's not the way you do it, because no investor, it doesn't matter if you're Warren Buffett, it doesn't matter if you're me, it doesn't matter if you're a hedge fund manager, no one times the market successfully over the long run. You might get lucky once or twice, but it is almost impossible to time the market consistently. So to have that in mind, you must never ever sell your indexes because you're really shooting yourself in the foot. And to explain this a bit further, we're going to go to my laptop now.
Alright guys, what we have here is the ASX 300 index. So this index follows the top 300 companies in Australia. Now as you can see here, this is a graph of the index going back to 2008, so about 10 years. So if you invest in this index, this is the stock price of the performance over 10 years. Now the thing you have to remember about this index is the ASX 300 has a dividend yield as well. So I think it's about 3.8%. So that means every year you're getting a 3.8% payout of your investment. So when you're passive investing, particularly in an index like the ASX 300, which pays a dividend yield, it's very important to reinvest those dividends. So when you invest in the index, you'll get a letter of confirmation from the ASX, and you'll be able to tick a box which says that I want my dividends reinvested. This is normally sent by the company that runs the index you're investing in. This is really important for long-term returns because it's really a lot of the gains that you'll get over the long term are actually from the reinvested dividends. And when the stock price is high, like here, you'll be buying fewer shares of the index with the dividends. But when the stock price is really low, you'll be getting a lot more shares for the same amount of money for each dividend, every time the dividend is paid every 6 months. So it's another form of compound interest and dollar cost averaging. So it's really important to have those dividends reinvested. So even though the gains over this period don't look too impressive, you've got to remember you're getting that dividend yield as well every single year, or it's usually paid every 6 months. So the worst thing you can do as a passive investor is try and time the market, as I said earlier. So a lot of people say, it's looking really high, say here, I think I'm going to sell. And, there's a bit of a dip here, I'm going to buy back in. No, you cannot do this because at this time, there is no way of telling whether the market is going to drop or whether it is going to go back up. Same at this time. You think, I'm going to pick the bottom, I'm going to buy back in here. No, it doesn't work that way, and you will get burned if you try and do this. So consider this. At this time of the global financial crisis, the stock market, as you can see, had a huge fall around this area. Now, as you can see here, there is a slight uptick before it falls again. So can you imagine if you reach this point here and you thought, oh yeah, the drop's over, I'm going to buy right back in. And then you can see your investment would have just tanked hugely down to the bottom here. So that's why it's really important not to try and time the market, because often you will get it wrong because the stock market is very deceptive. So you can see there's a lot of very deceptive short-term dips and troughs. A lot of people might have said, oh, I'm gonna, what if I just sold at the top here and bought at the bottom here? No, you got to remember at this time here in early 2009, every single newspaper was screaming that the index was going to go to 1,000, was going to go to 2,000. So now, it's easy in hindsight to pull up a chart like this and go, oh yeah, I can kind of see where the bottom and the top is. I'm going to buy in here, sell here, maybe buy the dip again. No, you got to hold it for the long term. That's what passive investing is all about. And what I was saying earlier about consistency, you should be putting money in when the market is here. You should definitely be putting money in when the market is here, because you'll be buying less shares for the same amount of money here and a hell of a lot of more shares when the market is here. So it's that consistency that ensures the long-term returns. You should be buying here, 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 here for sure, and just ensuring that constant investment that will guarantee you a long-term rate of return.
So there you have it, guys. I hope you've got a better understanding of passive investing. Now, as you can see, it's a really simple, really boring, but really rewarding over the long term way of investing. Now, as always, I'm not a financial advisor, so the information in this video is just general education and guidance. So please do your own research before investing. Okay, thanks so much for watching. I hope you liked this video. I'll be back with some more videos soon, but for now, good night.